Anyway, this is what the cover of the book looks like, and there are copies for sale, so thank you for coming to my infomercial. So there are only 6 chapters. They're a little longish chapters, but in the first chapter I talk about different views of how money has emerged historically, and so it's the debate between Mungarians, you might call them, people who emphasize the market origins of monetary institutions, and I would count myself among that group, versus the state theory of money, or sometimes called Chartalism. Keynes famously remarked that we entered the age of chattel money when governments not only proclaimed the right to enforce the dictionary, but to rewrite the dictionary, to redefine what it was that we count as money. But to say that we entered a chattel age suggests correctly, I think, that there was an age in which money was not chattel. It was not only at the behest of governments. But I'll say just a little about that. But I wanted to make the case for understanding money in a market context, because then it's not so weird when we get to Bitcoin, which is clearly not a chattel money. It is not risen by the actions of state actors. But what I do in the book is talk about how a gold standard works, how a fiat standard works. That's the kind of money we have today. How a Bitcoin standard would work or might work if Bitcoin were widely adopted as a money. And so it's a head-to-head comparison among these different monetary standards. So as I said in the first chapter, it begins with Menger versus Knapp and the state theory of money. Menger's the first one to give us a really satisfactory account of the origin of money out of market transactions. And his account has been criticized for certain simplifications, and understandably, because he makes it sound like we had a barter economy and people kept running into the frustrations of finding a well-matched trading partner so that they could trade directly the produce they came to market with for everything they wanted to go home and consume. But of course, that kind of begs the question of why have people specialized so much that they're having trouble trading? Actually, what you see in pre-monetary economies is mostly self-sufficiency. And so the use of indirect exchange, of producing stuff that you didn't, more than you wanted to consume in order to trade it for other things, that has to evolve simultaneously with the discovery and development of media of exchange. But you kind of dramatize the problem a barterer has by imagining that they're already specialized and now they have trouble trading. So Menger's been criticized by David Graeber, among others, saying, we don't observe any of these sophisticated barter economies existing before money emerges. Well, on Menger's account, you really shouldn't observe them because it's so hard to do barter. But in Knapp, you get the argument that we should focus on money that originates and is sanctioned by governments. And when you actually read Knapp's book, there's a lot of, I would call it wordplay. Knapp recognizes that, of course, there was privately issued money, but he says, I'm going to call that the private pay community. What I want to talk about is the public pay community, which is the money that's accepted by the courts, the money that is accepted in taxes, and so on. And he just kind of, by waving his hands, suggests that that's the interesting stuff, and this private stuff is going to play a very minor role, if anything. But there's lots of evidence that that's not right. So this is a statement by Menger sort of declaring his conclusion, and the the part that puts him at loggerheads with the state theory of money. Money's not an invention of the state, and so on. That's his conclusion. That's not really his argument. His argument consists of having a story according to which we understand why people in the absence of money have trouble trading. Direct barter means you're going to have a very hard time finding somebody who wants what you have and has what you want. And so people resort to indirect exchange. They trade whatever they're producing for something that gives them a better chance, something that's more widely acceptable. Menger talks about the different saleability of different goods. So a historical example was salt. People would trade for salt knowing that just about everybody would accept salt because everybody consumed salt. And so salt was an early monetary standard. But there were many commodity standards, well, that are kind of on the way to becoming commonly accepted, but are only partially commonly accepted. But then the second part of his story is why people would converge on a common medium of exchange. And it's not that difficult to understand. If you're trading your output for something you're using as a medium of exchange, you want to be alert to what is widely accepted by other people, or what you have the best chances of successfully completing your trades with. So if you see a bunch of people who are willing to be paid in salt and they're selling things you want, well, then you accept salt too, because you know you can use it to buy from them. But by accepting salt, you've now enlarged the community who accepts salt by one person. And that makes salt more attractive to other people. So like a snowball rolling down a hill, it will gather additional adopters. And historically, of course, you get different commodity monies in different places depending on local circumstances. You get shells in some places. You get barley in some places. You get copper beads. Eventually, we know gold and silver sort of came to the forefront. So that's the market origin. It arises from the economic relationships that are independent of the power of the state. These early commodity monies were not imposed on anyone. Adam Smith had pretty much the same idea, but he didn't spell it out quite as systematically. Smith uses the phrase that the money we have, meaning gold and silver, emerged by common consent, as opposed to having been imposed by some ruler. In the rest of the chapter, I talk about the market origins of further steps in the greater sophistication of money. So market-based coinage, private mints. I have an article a couple of years ago in the Economic History Review, and I steal some of the details from that. Banks come along. Banks come along because there's a market demand for a money that you can rely on. And by that point, so we're talking 1200 AD, coinage had been monopolized by local rulers. So in medieval Italy, there's dozens of city-states, and each city-state has its own mint run by the government, and they're all debasing their coins in order to gain revenue. And so you go from one city to another, you have to change money. They won't take out-of-town coins. They don't know what they're worth. You have to go to an expert, a money dealer, a coin changer, to get local money. And these coin changers become deposit bankers because businessmen will leave coins with them and pick them up later. And the bankers provide the service of denominating accounts not in the names of coins because their silver content changes from year to year, but in pure silver units, what economic historians have called ghost monies. Ghost monies in the sense that there isn't any coin that actually still corresponds to the weight of silver that's denominating the bank accounts. But the bankers are improving money payments for people by relieving them from the trouble of assaying their coin and weighing it in transactions. Now you just accept a bank transfer, and if you trust the banker, if you want silver, you go to the banker and he'll weigh out enough silver for you. So the medieval bankers symbol that they hung in front of their shop was a balance scale. They spent a lot of their time weighing coins. Banknotes come along later. I'll say a little about them. But today we don't have a commodity standard, neither gold nor silver. We have fiat money, where fiat means a decree. Right? Back when God spoke Latin, he said, "Fiat lux, let there be light." So fiat money is money by government decree, meaning it's not a commodity money that has a different basis for valuation. It's irredeemable money issued by government. And to illustrate it, here are Federal Reserve notes, 1950 versus 1993. This one says, "We'll pay the bearer on demand $100. Right? So that's still based on a commodity. Silver at the time. You could still redeem your Federal Reserve notes for silver. By 1993, that promise to pay had been replaced by a ribbon. So not "we'll pay the bearer on demand," just ribbon, 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 $100. So this is money by decree, by fiat. So why did this happen? Well, to summarize very briefly, market evolution, and I talk about this in more detail in the book, gave us silver and gold coins from private mints, payment by bank check, banknotes, and of course later developments in ways of transferring bank deposits like wire transfers. So transferring money was the killer application of the electric telegraph. Half of the telegraph operators worked for banks in the late 19th century. And by the way, they encrypted their messages to one another. So we had crypto money back in the 1890s. And now, of course, electronic fund transfer. So that's the market kind of money. But no doubt, I mean, undeniably, governments have played an important role. They established government mints and they outlawed private mints. They established central banks as branches of the government. And they eventually introduced fiat money. They took away initially central banks issued redeemable money, then they ended redemption. And that happened in the First World War. And by that point, the central banks held all the gold reserves. So if they said, "We're not redeeming for gold anymore," there was nowhere you could go to get gold. You were stuck with the fiat money. The interwar period, of course, was chaos because central banks were more or less reluctantly trying to reestablish something like a gold standard, but they had lost a lot of their gold, so they were trying to do things to economize on gold. The Bretton Woods system after the Second World War was supposed to bring order back by a system where other currencies were redeemable for US dollars, and the US, having the biggest gold stock, made the dollar redeemable for gold. They're at $35 an ounce. And so there was still a link to gold until Nixon shut the gold window in 1971. And this is a picture of the actual television address he gave. I superimposed it on an old TV. But he said, look, we have to end redeemability for the dollar, but don't worry. Well, first, who did he blame? Did he blame the fact that the Fed had issued more dollars than could be redeemed at $35 an ounce? No, he blamed it on foreign speculators, which was a little weird because the only people who had the right to redeem dollars for gold were foreign central bankers. And the troublemakers, of course, were France more than any other country. But in order to not have the speech be a complete downer, he also announced wage and price controls in the same speech to show that he was taking decisive leadership. All right, well, I said I'm doing a head-to-head comparison of different monetary standards. Here's the US gold standard period, tinted yellow, and There is variation in the price level, but if you look at the year the U.S. joined the gold standard after the Civil War, 1879, and the year the international gold standard ended, 1914, the total change in the price level is about as close to zero as you can get. Yeah, it went down a little bit but so there is a deflation for several years. It's not a vicious deflation though. The price level is sagging because the output of goods is growing faster than the global supply of gold. Right? So it's not a symptom of a depression, or it's not a cause of a depression. It was actually a period of pretty good growth. But there's a self-correcting property in a gold standard where, as the price level falls, the purchasing power of gold increases, and that sends a signal to gold miners, hey, it's profitable now to dig a little deeper, produce more gold, and the number of ounces per year coming out of the mining industry increases. I got lots of supply and demand diagrams in the book, and I have to have both stock diagrams for money supply and demand and flow diagrams to illustrate what's happening in the gold mining industry. And then these two sectors interact. But when the gold mining industry is producing additional ounces of gold beyond any industrial demand, the excess goes into the mints, and then the money supply grows, and gradually the price level comes back up to kind of the long-run equilibrium determined by the marginal cost of extracting and minting gold. Assuming that hasn't changed, you get mean reversion. You get a very flat long-run trend. And you can see the same thing in British data, which go back farther because they didn't suspend payments during the US Civil War. After the Civil War comes the interwar period. Let's not count that against fiat money. It was a mix of fiat and gold elements. This is the Bretton Woods system. I'm not sure how to classify that. But if we just look since the gold window closed, 1971, the average inflation rate up to the point where Selgin and Lestraps and I published this table was 3.8%. So that's just taking the post-war period, and it's worse. It's worse than the gold standard produced. In principle, you can manage a fiat money standard to give you lower inflation. You could hit zero. Well, it's hard to get lower than 0.006 without going negative, but you could manage it to match the performance of a gold standard. It just hasn't happened anywhere. Some countries closer than others. Japan, pretty close to zero in the long run, but half the time negative. Switzerland, pretty low, but still not better than the gold standard. How are we doing today in the US? A lot of people were puzzled by how many voters in this election campaign were upset about inflation, because they said, look, yeah, a couple of years ago inflation was high, but it's come back down. If you just look at the last 6 months, inflation was only 2.1%. And that's true, but maybe voters have longer memories than that, than 6 months. And when they look at their grocery bill, they're remembering what they paid 4 years earlier. So here's the US CPI measured by the 48-month change in the price level. And back here, it's in the range of 4 to 8%, so that's 1 to 2% inflation a year. But in 2024, it reached 20%. So that means an average of 5% inflation over the last 4 years. And that was salient to people, I guess. It's not just the US. If you look across countries, this is a table that came from a working paper by Rolnick and Weber. The paper was eventually published, but without this chart, unfortunately. But they look at as many countries as they can find that have both a long period of a gold or silver standard and a long period of fiat money, and ask what was the average inflation rate. Every country had lower inflation under commodity money. The averages they come up with are negative 0.5% for gold and silver standards, 6.5% for the fiat standards, and that's tossing out the German hyperinflation. Because if you toss in, 1,000,000% inflation, it kind of skews your average. some countries had, relatively moderate inflation under fiat standards, around 5%, but others above 10%, and then of course Argentina and Brazil, 50% per year. And actually it got worse in Argentina since they published this table. The average inflation rate in Argentina, on the verge of Milei being elected, was over 60% per year since the Second World War. So fiat monies work very badly in some countries. And so the kind of implicit message of the book that there are alternatives is most relevant in countries that have the most trouble keeping their inflation rate low. I'm not advising countries that have 2% inflation to scrap everything in order to readopt the gold standard. But you can understand why people in countries with really high inflation like Argentina are interested in alternatives. And of course in Argentina the alternative is dollarization. You don't go back on the gold standard when nobody else in the world is on the gold standard. But a lot of people are on the dollar standard. Lots of transactions are on dollars. Everybody knows what the dollar is worth, so it's not a big calculational problem. And so Milei actually promised to dollarize the economy and shut down the central bank. I'm not quite sure why he's dragging his feet on that. I was in Buenos Aires this summer giving a talk on why he should follow through on that promise. He only spoke at the end of the conference, so I don't think he heard my talk, which is too bad. If you look around the world, all right, quite a variation in inflation rates. And the countries I've highlighted in yellow are the ones where inflation is the highest, and so the idea that there are alternatives to what they're doing now, they're going to be the most interested. So Venezuela had a hyperinflation. By 2022, they were down to 156% a year. Argentina at that point was 88%. It went up since then. Sri Lanka in the 60s, Turkey in the 80s, Zimbabwe, of course, perennially has triple-digit inflation. All right, so the main cause of triple-digit inflation has to be triple-digit monetary expansion. If you remember the equation of exchange, MV equals PY, change in the price level could in principle be due, the price level rising could in principle be due to real income collapsing. So if you had 100% inflation, it would have to be real income cut in half. That just doesn't happen. You have countries with weak growth, but that's only going to contribute a couple of percentage points. Or it could be a doubling of the velocity of money. Well, that doesn't happen either, empirically. So changes in velocity and real income can explain small wiggles in the inflation rate. But for really high inflation, it's got to be monetary expansion. So the problem is, and especially in countries with really high inflation, is restraining the issue of fiat money. So how do you do that? Well, famous argument by Kydland and Prescott made, once again, many other people had made a similar case or made the case on other grounds for imposing rules, that is, binding set of instructions on central banks that will prevent them from issuing money too rapidly. But I'm going to talk about the second alternative, which was brought out around the same time. This is Hayek's denationalization of money. So this is the Hayek lecture. Good thing to mention Hayek. This is not the Hayek that most people read, but this is Hayek who, well, a little bit of history of thought. Hayek has a debate with Keynes in the 30s. Keynes is declared the winner. Hayek continues to criticize Keynes's theory. There are a few chapters in the back of The Pure Theory of Capital, which is my favorite book by Hayek because I'm the only one who's ever read it. Well, in most rooms, I'm the only one who's ever read it. But when Bretton Woods comes along and the rest of the economics profession embraces it, Hayek is kind of shrugging his shoulders. He said, I stopped talking about monetary policy because I wasn't going to get any respectful hearing. So I moved on to other topics. Then Hayek wins the Nobel Prize in 1974, and he's reinvigorated And it occurs to him that maybe people will read something I write about money. And he's also energized by the fact that there's 20% inflation in Great Britain. And so for a British think tank, he writes this monograph in which he poses the question, why do we have such lousy money? This is the way he frames the problem. He doesn't take it for granted that we should reform the central banks according to some formula. He says, we have lousy money because we don't have any competition. We have good cars because we have competition in the automobile industry. We have good televisions because we have competition. We don't have good money because we have national monopolies. And a government that messes up and produces high inflation, like 20%, the Bank of England, doesn't lose its customers. We want to put that fear in them. Hayek's first suggestion was pretty mild. It was just let people use whatever currency is available throughout the world. So let people in England open bank accounts in Deutsche Marks or Swiss francs or whatever they want. He called that choice in currency. But a couple months later, he said, I had another idea. Why don't we open the competition to private firms? That's the denationalization of money. So that's his proposal. Then he has a prediction, which I would distinguish from his proposal. His prediction is these private firms would issue money that, in order to attract customers, would promise to keep the purchasing power constant. So zero inflation, stable price level. He doesn't see them writing a contract that makes that enforceable. He just says the reputation will be important to them. They'll be covered in the press every day. If a currency starts to lose a little bit of value, then they have to worry about losing customers, so they'll quickly respond to that by tightening the creation of money, and that will work to discipline it, and we'll get better money that way. Well, with the introduction of Bitcoin and its hundreds of copycats and modifiers, we now have private assets that would like to be money, that are hoping to be money. They're not designed anything like what Hayek predicted. They don't promise a stable purchasing power. So Bitcoin, of course, is the biggest. It's currently worth 1.3 trillion, all the Bitcoin in circulation. That's pretty amazing. It's very successful as an asset, as a new asset class for people to invest in. And of course, if you got in early, what are you doing here? You should be off on your yacht. People made a lot of money, and this is a little bit out of date. This is the number from Monday.
Yes, it's like 75.
It's currently 70, right? Or
I saw 75.
Or 75. Okay, so at 75, there are basically 20 million coins in circulation. It's worth 1.5 trillion, not 1.3 trillion. People have reintroduced easily accessed claims to gold using the same blockchain technology. They got gold on the blockchain. Now, what that means is it's another way of issuing claims to gold. So Tether Gold, right, not as popular or famous as Tether US dollar, but it's available, is backed or is redeemable for gold that's being held in vaults in Switzerland. If you believe Tether, Tether's a little dodgy, a little iffy about their transparency of their balance sheet. A more reputable version is Pax Gold, and they've got hundreds of millions in circulation, but of course that's a small fraction of what Bitcoin has in circulation. And then people have reintroduced kind of gold-denominated banks where you can write checks to anybody who also has an account at the same bank, which is not many people. So these are not really being used as media of exchange yet, just as an easy way to invest in gold. But that's been the fate of Bitcoin too. It's become an investment vehicle and not so much a transactions vehicle. But if you want to see a dramatic illustration of how both Bitcoin and gold can reemerge as media of exchange, actually be used for payments, get in your time machine and go back a few years to Venezuela when the hyperinflation was at its peak. And this was unique to Venezuela. The government was very heavily suppressing the use of US dollars. Usually in a high inflation Latin American country, it's US dollars that everybody switches to. But they were stopping that, and people were actually making payments with flakes of gold. Venezuela still has a gold mining region. So people coming out with these irregular pieces of gold, shops would accept payment in gold, and they had scales on the counter. The little flakes of gold are being wrapped up in this Bolivar note, but the 500 Bolivars was worth less than a penny. That's not the money here. That's been demonetized in effect. So the article that this picture came from was interesting. The reporter went around this gold mining town and said, as far as I can see, about 2/3 of all the transactions are being done in gold. And I talked to one of the shopkeepers and said, how do you know this is real gold? And she said, well, I did get swindled a couple times in the beginning, but now I can tell real gold from fake gold. I'm waiting for a private mint to be set up, but hasn't happened. Meanwhile, in the cities, and of course, this picture is completely faked because there is no physical Bitcoin. People were transacting in Bitcoin because the Bolivar was melting away in value so rapidly, they were willing to put up with the volatility of Bitcoin because the trajectory is at least not downward, it's flat or upward over long periods. There was an interesting article in the New York Times called How Bitcoin Saved My Family. And the guy described how, when the economy was falling apart, he managed to make an income by doing business online. He was a copy editor. And he could do that online for foreign clients. They couldn't wire him dollars, but they could wire him or send him Bitcoin, because it's a different set of payment rails. Can't be stopped by the Venezuelan central bank the way dollar payments can. So he was making an income in Bitcoin, and then when he needed to buy groceries, and the grocer wasn't taking Bitcoin, there was a local market. Other people who wanted to put their savings in Bitcoin would happily trade Bolivars for Bitcoin, and then he could go shopping. Of course, he didn't want any more Bolivars than absolutely necessary to buy the groceries. When his brother wanted to leave the country, how is he going to get his wealth out? Couldn't carry a suitcase of $100 bills out. They'd be confiscated at the airport. But Bitcoin, all he needs to remember is his address and his password, and he can just walk through the border. If you find yourself in that situation, don't put that information on your phone, because the customs authorities will search your phone in a country like that. But just memorize it. So there is a sort of niche where Bitcoin plays a very useful role, and that is as a kind of payment that has its own set of payment rails that nobody can blackball your transaction. Nobody can blacklist you. The transaction will go through. So it's censorship resistant, is the way the Bitcoiners put it. Whereas dollar payments can be censored. You want to send money to a dissident group in Belarus that believes in democracy, they're not allowed to have a bank account. You can't send them dollars. You can send them Bitcoin. Completely different payment rails. And then, like the people in Venezuela, they can use it by trading it locally for the local currency. So it's not redeemable, it's not a commodity. It doesn't have any purchasing power assurance. It doesn't have the mean reverting property that gold has. And that's because what the program promises you is not a purchasing power, it's the quantity. The quantity is pre-programmed. So you know it's not going to be hyperinflated, because nobody can go out and just arbitrarily create more Bitcoin than is already scheduled to be produced. So this is a model like a limited edition art print. You buy a Andy Warhol for $3,000. What guarantees that it won't be sold next week for $2,000? Because nobody's more money grubbing than the Andy Warhol estate. It's not the signature at the bottom. That's fake. It's the numbering on the art print. This is number 160 out of 3,000. If you see a duplicate 160, you've been cheated. Right? They guarantee you that they're not going to issue more than 3,000. And that's a good way to make a, Coase discussed this back in the 70s as a way of reassuring people that they weren't going to have the rug pulled out from under them in an article called Durability and Monopoly. So that's the guarantee. It's a quantity pre-commitment, not a value pre-commitment. So where did it come from? So it's all open. It's not issued by a business firm. It was kind of a hobby project where people online, people came to be called cypherpunks. Cipher for cryptography and punks because they had a snot-nosed attitude about institutions. And they were trying to, fight the system by creating a privacy-preserving and reliable, non-inflatable currency. So they're talking about the problems of doing that at a fairly sophisticated level because these people are all cryptographers. And somebody arrives calling himself Satoshi Nakamoto, and he says, oh, well, I've solved the problem. Here's my white paper about how you can have a peer-to-peer internet currency. And I've solved I have a version of a solution to the double spending problem, meaning the problem with digital files is it's easy to copy them. But if you can copy your money file, then you can spend it twice. That's going to be a problem for maintaining the value. So that's part of the thing solved by the Bitcoin program. But a couple months later, he releases the program, and it's all open source. Anybody can examine the program. And they did a few months of bug fixes. But then everybody who wants to can download the program. You can do that today. Download the program and start mining Bitcoin. At the very beginning, every block that you mined, you got 50 Bitcoin. Back then, what was 50 Bitcoin worth? Nothing. It didn't have a defined price. Nobody was trading it. Eventually, other people heard about this, and they said, that sounds cool, but I don't want to set up and run the program on my computer. Will somebody just sell me some? And then somebody set up an exchange. And the first quoted prices for Bitcoin were a fraction of a cent. Right? There were thousands of units already out there, and there isn't any use for them. So it's all people thinking, well, maybe someday it'll be worth something. But if you read sort of comments people make online, people saying, I bought some because I like what it stands for. Well, you'd like it more if it actually worked for something. And once prices were quoted, they started going up. So what was motivating Satoshi he blogged about what he was doing, and this is from one of his blog entries. The root problem with conventional currency is the trust that's required to make it work. The central bank must be trusted, not to debase the currency. But the history of fiat currencies is full of breaches of that trust. That's the number one problem. Now, I got caught up with the people who were the cypherpunks. I am not Nakamoto. If I were, I'd be a lot richer. But the two main people who are suspected of being Nakamoto are Hal Finney and Nick Szabo. And I hope so, because I interacted with those guys. This is in the 1990s, so well before Bitcoin. But Hal Finney created something that was a prototype called reusable proof of work. And Nick Szabo created something called BitGold, which was a prototype. And he said, what I'm trying to do is create a digital money that has all the virtues of a gold standard. So quantity cannot be manipulated, but doesn't have any of the vices of a gold standard, like you got to have a big vault to store it, which is insecure, and governments can come knock on your door and take all your gold. I want to make it secure against that. But George Selgin and I were like the only people writing about private free market money in the 1990s, and so they read us, and I was on a discussion group with Szabo, and he gives me and George some credit for our work on free banking. This was an article in a completely obscure publication called Extropy, but the extropians have been given a fair amount of credit for also being part of the seedbed in which Bitcoin arose. Extropy is the idea that the universe is getting better and better. Right? It's the opposite of entropy. So these are optimistic, libertarian futurists. And Nakamoto comes out of that community. All right, so now we have Bitcoin. What do we make of it? How am I doing on time? Time to wrap up. Even some very good economists like John Cochrane are a little bit confused about it. In the same paragraph, he says Bitcoin is a pure fiat money because it has no backing. La, la, la. It's an electronic version of gold. Well, now wait a minute. Gold is not a fiat money. So how can you say both things? He means that the quantity responds slowly or not at all to changes in its value. And that's why he thinks we should be careful about returning. People who want to return to a gold standard should observe how volatile the price is. Sorry, Lucas critique. If you want to observe how gold behaves when it's monetized, go back and look at the classical gold standard. And you'll see the kind of chart I just showed you, where the price level isn't volatile and keeps mean reverting. If you observe the price of gold today, when it's been demonetized and become purely a speculative asset that nobody uses as a transaction medium, you're going to see something very different. So it's not a fiat money in the sense that it's not issued by government decree, but it also has a kind of rule that most fiat monies don't have, which is the quantity commitment. So very different supply mechanisms. Now, in the book, I have lots of supply and demand diagrams, but let me be quick. If there's an increase in the demand for gold, for monetary gold, that will raise the purchasing power of gold. Right? We saw that in the diagram where the price level was sagging. But that will set miners to work, and over time, that's the dashed line, you'll get an accumulation of mined gold that will bring the purchasing power of gold back down. And if the marginal cost of extraction hasn't changed between those 2 points, it'll come all the way back down. So you could connect these points and say, as Milton Friedman did when he was analyzing the economics of a commodity money, you could say there's a flat long-run supply curve. Right? That's not what Bitcoin does. Bitcoin, here's the release schedule. The rising line tells you how many Bitcoin will be in circulation. And you can see it's getting flatter and flatter. Every so often, the rate of rewards gets cut in half. And in about 100 years, we'll hit the maximum of 21 million Bitcoin in circulation. We're already close to 20 million, so 95% of all the Bitcoin's already been mined. So the quantity is almost not going to change at all, but even when it does change, it's not in response to anything that's happening to the purchasing power. So it doesn't have that mean reverting quality. So Bitcoin supply curve vertical, gold supply curve is upward sloping in the short run. People will melt down jewelry and coin it in response to a higher purchasing power of gold. But the dramatic contrast is in the long run, where the supply curve for Bitcoin is still vertical, but the supply curve for monetary gold is pretty flat. Right? So you get much more reliable purchasing power stability. Historically, these numbers are from Hugh Rockoff. Gold supply grew at an average of close to 3% a year, but it varied depending on whether the price was high or low. When the relative price was high, you got more mining, faster growth, slower growth at other times. There were supply shocks, but they weren't all that big. Bitcoin, no supply shocks, but doesn't respond to changes in demand, so much more volatile. And the volatility is built in. So here's what you expect if you have Bitcoin and you don't turn off the alerts on your phone. Oh, it's up 5% today. Oh, down 5% today. Oh, up 6% today. I got diagrams showing Bitcoin's volatility, that is how much the price changes over 60 days, average 8.23%, much more than gold, even demonetized gold, and more than foreign currencies. On a daily basis, same thing. The red spikes are Bitcoin. Bitcoiners tell me, no, the volatility's come down. It was high before, but now it's come down. Well, it only came down between 2010 and 2014. If you plot average volatility from 2014 to the present, flat. And because of that, the people who used to use Bitcoin to buy and sell Ether and Litecoin and Dogecoin and other cryptos have stopped using Bitcoin for that purpose. It used to be the common accepted medium of exchange in crypto markets. Now it's stable coins, that is, cryptocurrencies denominated in dollars, mostly Tether, are used in those markets. And you can see it, so this was a couple of days ago. Bitcoin's got 1.3 trillion, so as I said, it's now 1.5. But if you look at the 24-hour transaction volume, it's only 34 billion, whereas Tether, which has denominated in dollars, which has 1/10 the value in circulation, has nearly double the transaction volume. That's evidence that people care about volatility of purchasing power when it comes to choosing a transaction medium. And that's why I think, that's why I agree with Vitalik Buterin, the developer of Ether, who said 10 years ago, Bitcoin or any other fixed supply currency is going to be too volatile to ever be stable as a unit of account, meaning as a transaction medium. What do we do about that? We need to experiment with other designs. So the fact that Bitcoin is not suitable doesn't mean no crypto will ever be suitable. In order for people to get off the dollar standard, though, they need to have a good reason. They need to be offered something that's much more stable, and Bitcoin is not it. And right now, the dollar is not all that unstable. So I don't expect a big switch either to a new gold standard or to a Bitcoin standard unless there's really high inflation in all the fiat currencies in the world, and that's not something to be hoped for. But if that happens, always good to have a plan B. Gold seems more plausible to me as a replacement because it's actually got a larger installed base of users. All the gold in circulation above ground is 13 trillion, so almost 10 times Bitcoin's. And the purchasing power is less volatile. It's true that Bitcoin is harder to censor, but governments can drive it underground, and of course they do in China. And when it's underground, it's not going to become a commonly accepted medium of exchange. But it might be possible to design a different cryptocurrency with, well, they've designed stable coins, of course. Those are only as stable as the US dollar. So in my scenario where the US dollar becomes highly inflationary, that's not a way out. But people are now thinking and designing flat coins, meaning they index the value. They try to keep the purchasing power constant, not just the dollar value. And disclaimer, I'm an advisor to a project which is hoping to do that. It's months away from actually being available. So, and besides, I don't benefit if the price goes up. Well, actually I do. They gave me lots of units of this currency that's currently worthless. That was true of Bitcoin at one time. So, final conclusion, it's an experiment. Cryptocurrency is a market experiment, but to get the benefits of experimentation, we have to let it run and not suppress it. So that's the normative conclusion. This is Nick Szabo saying we need to test these things to see how they're going to work, whether they're going to work, whether they're going to provide the kind of money that people actually want. So thank you for your attention, and I'll take questions. Raise your hand. In the back.
What about other cryptocurrencies like Ethereum, Litecoin? Are they better suited to be a currency of some sort?
So Litecoin basically is a clone of Bitcoin with a larger block size. So it's got the same quantity limitation, so it's got the same volatility problem. Ether recently switched from the Bitcoin type protocol, which is called proof of work, to something called proof of stake. And I don't understand right now what the quantity commitment is in the case of Ether. So if they changed the quantity commitment to one that had feedback to the price, then potentially, but I'm not sure what they're doing right now.
The limitations of the speed of Bitcoin blockchain, like I know the Lightning Network exists, but
Right.
those pose considerable charges to fully adopt Bitcoin.
Yeah, so another reason that Bitcoin has had trouble getting adopted was back when there was the big run-up in interest in 2017, people had to wait days to get their transactions validated because the blockchain became very congested. And that's because the way Bitcoin is designed, there's only a block every 10 minutes, and the block is only a certain size. They can only process about 7 transactions a second, whereas Visa processes tens of thousands of transactions per second. So congestion is a problem, but it is a technical problem. So as you mentioned, the Lightning Network, which is not succeeding as much as people hoped, but there are second layer solutions. So for example, if there were Bitcoin banks, you could transfer claims to Bitcoin, and that can be done instantly. The problem is creating a Bitcoin bank when nobody in their right mind would want to borrow Bitcoin, because who knows what you're going to have to pay back. Right? So that's an obstacle to having cheap payments in the traditional way. But if somebody comes up with claims to Bitcoin that are trustworthy, then possibly you could have faster transactions. So I don't think that's the real obstacle that I want to emphasize. I want to emphasize the purchasing power volatility. Yeah.
Is it possible that the state or whatever nationalizes Bitcoin or adopts Bitcoins as a means of exchange? And if this happens, what would be the consequences for?
Yeah, there are central banks that have what you might call a fear of missing out and have proposed to issue what they call a central bank digital currency. And there are 2 models for that. One model is to have a cryptocurrency with a blockchain, but at the same time, they don't want to introduce a new currency unit, so a dollar CBDC would be pegged to the existing dollar. So it would be more like a stable coin issued by a central bank. That's one model. The other model, which is more popular with the authorities, is something called the first one was Fed coin, the second one is Fed account. Everybody could have an account on the books of the Federal Reserve System. At that point, it's not really a currency, it's a deposit claim. But anyway, the advantages are supposed to be instantaneous settlement. Don't have to wait a couple days for your check to clear. Well, waiting a couple days for your check to clear is already being phased out by improvements in the clearing system, which the Fed has been very slow to adopt. But the Fed's clearing system isn't even open on weekends. They're opening something called Fed Now, where it's going to be open 24/7. And so checks will clear faster without introducing a new monetary unit. But lots of central banks around the world are talking about a central bank digital currency on some kind of model where people have electronic claims on the central bank. And the biggest objection is that if you have an account, and especially if all your money is in an account on the books of the central bank, then all your transactions can be surveilled. And of course, we have defenders of the system promising that that won't happen, but there's going to be a lot of pressure. Right? The FBI wants to see your transactions in real time. The Fed's not going to say no. Yeah.
I know that there's a lot of government skepticism around cryptocurrency in general. In the past year or so, Jamie Dimon was in Congress to testify.
Yeah.
Former president and now President-elect Trump positions himself as the most pro-crypto candidate. But what do you posit that means in terms of regulation or deregulation, allowing greater ETF creation?
Yeah.
What's the
Well, so Jamie Dimon is a hypocrite. At the same time he's in front of Congress denouncing crypto, he's got an arm of his bank developing
right.
cryptocurrencies, their own proprietary stablecoin. And when Trump says he's the most pro-Bitcoin or most pro-crypto candidate, I think Kamala Harris said the same thing, and it's hard to believe either one of them. It's just a campaign promise. But I would say the biggest federal regulatory obstacle right now is the Securities and Exchange Commission, which is sort of making rules up as they go along. And the way they introduce a rule is they sue a crypto company for something that they didn't know was a crime. And if the court agrees with them that it's a crime, now they've got a precedent. So mostly it's settled out of court and it's just used to intimidate everybody to pay attention and follow the SEC's guidelines. But those are restricting entry. And in particular, they're defending the status quo payment institutions against wider use of stablecoins. Because the stablecoin issuers are, don't let it get out of this room, unregulated banks. They are issuing claims to dollars without being subject to oversight by the Federal Reserve or the FDIC. Now, I'm in favor of unregulated banking, but it has to be in a context where people accept caveat emptor. Because if everybody, it's a big temptation for fraudsters, so you have to be very careful about whose claims to pay you back you can believe. There was, of course, the Sam Bankman-Fried fraud, where he claimed to people that he was safeguarding their crypto. He was just a custodian. He had $8 billion in claims of Bitcoin. People had deposited $8 billion in Bitcoin with his firm. When they had to shut down the firm because they weren't paying people, how much Bitcoin did they discover? 0. He sold it all to invest in fly-by-night crazy schemes that didn't pay back. So there's a big hole in the balance sheet. So there have been some ugly episodes which justify people being extremely skeptical. But my hope is that with, sunshine being the best disinfectant, people will learn to avoid the fraudsters, and companies will start competing on reputation. I've been critical of Tether and USDC for having very thin capital, which makes them dangerous. And they were leveraged like hundreds to one. They had capital of less than 1%. Tether has since, and so even a small loss can wipe them out. Of course, they said we have a perfectly safe portfolio. We know that's not true. Well, we don't know exactly what Tether invests in. And USDC, we found out that they had more in a deposit in Silicon Valley Bank than their entire net worth. So when Silicon Valley Bank was closed, USDC depegged, went to 77 cents. Until Monday when the FDIC said, we're going to cover everybody. And then it came back to $1. But that's not a safe way to operate. So somebody who understands sound banking needs to offer a superior product. And I'm confident, I've been disappointed so far, but I'm confident that that will happen if we let it happen. And what's the advantage of that? Stable coins are faster and cheaper than the legacy payment system we've got. And those are real benefits.
I think we'll have to, maybe the one last.
Okay, last question to Richard.
Yes, thank you. Great talk. I don't know when Hayek said this, but I remember Mises saying, I think he died a couple of years after the Bretton Woods system, that a fiat standard wouldn't go very long without causing hyperinflation. Are you surprised? Do you think he would have been surprised if, looking back now, we had all these fiat currencies and they have been inflationary? But would he be surprised that they haven't been so inflationary? Untethered the way they have, wouldn't he have predicted much worse inflation of the 1970s type chronically? And if not, why not? Why is it not as bad?
Well, it hasn't been that bad because although they were kind of steering without a map or a compass after the end of Bretton Woods, they figured out the quantity theory of money and realized that if they want to control inflation, and of course Paul Volcker was sort of the personification of that. He understood that you need tight money if you want low inflation. And so many central banks have learned that lesson. As we saw, there are ones around the world that didn't learn that lesson. In Turkey, President Erdogan decided that paying interest is a cost to businesses so that if we lower the interest rate, we'll reduce inflation. Yeah, that didn't work out. Because to lower interest rates through monetary policy means issuing abundantly in the short run. But as to whether Mises would have been surprised, I don't remember him predicting hyperinflation with any kind of inevitability. It was, if you don't mend your ways, sort of prediction. This is where it can lead, and had led, of course. It was Irving Fisher who said, of course he wrote even earlier, paper money everywhere has proved to be a curse. And at the time he wrote it, it was true. The only time you had paper currencies were in war times, and they ended up hyperinflating. But central banks figured out that they don't need to do that. Of course, they need freedom from control by the fiscal authorities in order to pursue a tighter monetary policy. And the countries with hyperinflation are all ones where the government came and said, we got a payroll, please print the money to pay the payroll, and it was off to the races. So it's not inevitable, and I hope that central banks will learn the lesson even better. But we should allow competition from potential monies to keep them on their toes.
Let's thank